Well, good day there, well-pressed traders, investors, and viewers. It's time for another Monday Morning Roundtable, and this week I'm joined by Adam Sarhan, JeffZ, and Neri, and of course, Roger Scott. Gentlemen, welcome.
Thanks for having us on, James.
Always a pleasure. Okay, guys, this week we have a smorgasbord of asset price, I'm going to call it runaway trains. And I'm not talking just Bitcoin. I'm not talking just tech stocks. I'm talking commodities as diverse as steel and orange juice, all sort of reaching for new highs. What's driving this feeding frenzy in physical assets, Roger?
I think it's fear of inflation, and I think we've been talking about it quite some time. The short-term rates are staying steady. Longer-term rates, 10, 20, 30-year rates are moving higher. The bonds are breaking down. Commodity prices are the first in line to move higher, and I believe it's just a very simple sign that inflation is ahead of us.
Mm-hmm. And Jeff, are you involved in any way, shape, or form in the exploitation of the opportunities inherent in the commodity price explosion?
I'm bullish on the XME, the mining ETF. Roger and I have been talking about it on this weekly thing we've been doing for a while. He nailed the stock Freeport. I had it as a monthly money flow last month. And it's starting to get a little bit like incredibly fraught. Like the explosion is at the point where I'm like code red at this point. I mean, I think if you've been in the trade, congratulate yourself. But I think in the short run, it might play itself out a little bit, kind of like we were seeing in Bitcoin today, which really just like exploded through 50,000, went up to 58,000 over the weekend and traded under 50 this morning for a bit. So, when you start to see these parabolic moves, you need to cool it a little bit because they tend to play themselves out.
Mm-hmm. And Adam, what's your synopsis on the activity this week?
Sure. My thought process is very simple. We're going back to normal in the market's eyes. When you look at under the hood, you're seeing lots of different areas, a lot of rotation going on. The tech stocks, which have been red hot, are pulling back, and we're seeing that money flow into some of the undervalued areas of the market, such as the shipping stocks, like the tankers, the hotel stocks, the travel-related stocks, the cruise lines, the airlines, so on and so forth. The alpha trades this week, we put out Marriott Hotels, and the stock itself, not the options, but the stock's up 5% today. So we're seeing a big movement under the surface in the stock market from the stay-at-home trade to the back-to-normal trade. Now, the question becomes, is this going to be, in fact, a real back-to-normal environment? In other words, we're seeing hospitalization rates go down. We talked last week about the X, my COVID X, which is the number of cases in hospitals are going down and vaccines are going up, and that's a good sign. So will this continue, or will this be buy the rumor and sell the news? Meaning Bank of America had this big alert or this new research note go out saying you bought the rumor that we're going to get back to normal, but once that vaccine type scenario is out there, you want to sell it and get out of the way because that means the move's already done. It's baked into the market since the market's a forward-looking mechanism. And only time will tell. But for now, I'm bullish on the areas that are undervalued and that are catching a real nice bid here and moving higher.
Mm-hmm. So, Roger, let me ask you, to what extent would you counsel moving some capital into the physical commodities realm and away from stocks, or would you counsel more towards the ETFs that you're more well known for?
Quite honestly, and that's a really good question, and that's something I haven't thought of really, because I've over the past 15, 20 years, I've very, very slowly switched away from physical commodities and into ETFs. And now you have ETFs that actually track the physical commodities. So I don't really see a need for anybody to go into the physical commodities because their price levels will be in line with the ETFs. They have been. Like, for example, there's a corn ETF that tracks corn. There's a wheat ETF that tracks. There's just no need to go into a physical commodity. You have 3-month contracts. You have to roll over. You have depreciation based on premium. You have negative premium. It's just not necessary for most people out there. I mean, if that's your thing, and if you trade commodities, and I'm going to tell you, that's how I started. So I was a hardcore commodities guy 27 years ago. it's just not necessary right now unless you're creating an arbitrage. You can even do that with, I'm thinking maybe short-term rates versus long-term rates, but you could even do that with ETFs and equities as well nowadays. In terms of exposure to commodity or basic materials to stocks, let me just take this question to the next level. I'm not throwing in the towel on stocks and going full bore commodities. I think we have a lot of upside left. I think there's a lot of rotation, as Adam and Jeff both said. I think we have some hidden subsectors this year that are going to surprise us. I think we've got some amazing low-hanging fruits, but I really don't see a need to go into actual physical commodities because you could do everything in the stock market nowadays that you could have done years ago in the commodities market itself.
Mm-hmm. Okay, and so Jeff, do you have any sort of love for, you were exposed to gold several months ago, and I'm just curious as to how the sort of the kneecapping of the gold price has affected your position in that.
Yeah, I like to be there when the thing is moving, and right now it's kind of like dead money. I'm not a big fan of like coin flipping and figuring out what's going to happen. I'd rather already it be happening and try to come up with a mathematical solution from a move that I see occurring. And since gold is kind of like, it broke down, but I feel like it's hit like this, it's hit a near-term bottom, but I think there's going to be an overhang on the upside. So you can't really short it. You can't really be long it from a trading perspective. I think from a long-term perspective, you got to own gold. I think you got to own like a lot of things for a long term, but I like gold long term because I do see a collapse. I do see stress. I do see, I think we're kindred spirits on this one, James, on the long term terror of what central banks are doing. Like there's a big fallout. There's a big harm that's going to come from it, and I think gold is going to be a solution to that for a lot of people independently, but I don't know when or how that's going to be triggered. And I think it's kind of a fool's game to try to guess what catalyst is going to create that.
Okay, great. So Adam, what's your main sort of focus then for the week as far as the markets are reflecting right now?
Sure. So the main focus here is to see if this stay-at-home type stocks or this, back to normal stocks are working, or they're going to continue to work. I want to see what's going to happen with the overextended areas of the market, like Bitcoin and the commodities and some of that reflation trade that we spoke about here on the show for the last several weeks, if not months now. And then I've got a ton of earnings coming out this week. I believe we have Home Depot's reporting, Square's reporting, Lowe's is reporting, Berkshire Hathaway's reporting at the end of the week, Nvidia's reporting, Priceline, Booking.com is reporting, NetEase is reporting. So there's a ton of Melly's reporting, Salesforce.com, so on and so forth. So I want to see, of course, how all these stocks, what the numbers are. I want to see how the market and the stocks react to the numbers. But really under the surface, I want to see if this is going to be a small, shallow pullback in both size and scope. And I'll tell you what I mean by that in a second, in the leading areas of the market. And I want to see if the lagging areas, which are now catching a nice bid here, continue to run, or if they roll over. And what I mean by size and scope is that, we know markets go up, they pull back, they go up, they pull back. If the pullback is shallow, typically between 0 and 9.9%, it's considered a pullback. 10% to 19.9 is a correction, and over 20 is considered a bear market by most people. So if it's a shallow pullback in size, meaning it's the NASDAQ 100 or Cathie Wood's ARK Fund or whatever it is that you want to use as a good barometer for leading stocks, goes down 4 or 5% or 6 or 7%, that's a shallow in size. It's a single digit shallow pullback. If in scope, duration, how long does that pullback last? The last few pullbacks we've had lasted a few days, if not a few weeks. And that's that's an indication of how strong the bulls are right now. So if this pullback gets bid right back up again and we race higher like we did just a few weeks ago, then that tells us everything we need to know about the entire market. We still have a ton of liquidity coming into the market. I read this morning that the Treasury has, I think Yellen has a trillion plus dollars in the Treasury's bank account that needs to be deployed. And that's going to be, more money being flushed into the system. The fiscal side of it, the government's going to pump another 1.9 trillion, I believe it is, into the stimulus, into pockets of everybody. And that money has a funny way of ending up into the stock market. So from A macro standpoint, stepping back, this is, in my opinion, just another shallow pullback in size and scope. The market is extended. I'd love to see it pull into the 50-day moving average or some other area of support and then bounce and take off again. But for now, it's just the key is this going to be a shallow pullback or is it something more severe?
Mm-hmm. Okay, so Roger, to what extent would you say that the influence of the quantitative easing, past, present, and future, has now sort of become too much in terms of its distorting effect on asset prices in the marketplace? I mean, if you look at the commodities price action, one could deduce that, okay, the smart money's getting a little bit wary of the tech trade and has decided that, you know what, we've maxed out our quantitative easing effect on market prices generally. It's time to load up on physical. So sort of a circular argument, because we're back at the beginning of the conversation. And it makes me wonder, though, to what extent should we be preparing to abandon technology altogether for the near term?
Well, to be quite honest with you, I was doing some analysis this weekend on tech, and what I'm seeing is not an overbought bubble in tech. What I'm seeing is a bunch of companies actually coming up with numbers. A lot of traders and investors are comparing what's happening now with tech to what happened in the early 2000s. The problem with that is there was no numbers back then. It was all based on fantasy money. Now we actually have techs making a lot of money because the world is a lot more advanced and relying on this tech, especially for the last year and a half, 2 years. As we were gearing up, tech got more advanced. Then we had COVID. So I think what we're going to see is not a. I don't want to throw the baby out with the bathwater in tech. I think we're going to see we're going to see the strong get stronger. We're going to see a very natural Darwinian type of a reaction in tech over the next several months. I think a lot of the smaller tech companies are going to start moving higher. I think a lot of the larger tech cap stocks are going to start moving sideways. But I wouldn't call this a tech bubble or something similar to what we had in the early 2000s. I don't think we're there at all. I think the valuations are extremely positive. As a matter of fact, there's an international chip shortage right now. That's not what we had on the table 15, 20 years ago. So I think what we're going to see is, I think the market's going to become a bit lopsided. I think certain sectors are going to become more favorable than others. And we're seeing that right now. As both Jeff and Adam said, that we're seeing some sector rotation. For example, right now, I'm seeing a major breakdown in healthcare. I'm seeing a breakdown in consumer staples. I'm seeing a breakdown in utilities. But on the other hand, energy, financial, consumer discretionary, technology, industrial, I'm seeing even a breakdown in basic materials, but not industrial. So there are some breakdowns and going on right now, but I don't think what we're seeing right now is a major turn in the market. I don't think we're there yet. I think that I think we need a little more. I think the carrot is just getting bigger right now, and I think we may see some action following the stimulus and seeing what happens afterwards. But I think the market is way too bullish right now. And I think this is just a volatility play. And worst case scenario, I'm seeing it go to the 50-day moving average. But the way the sectors are looking right now, the way the speculative sectors are looking right now, I wouldn't make too much out of this. I think it's too early.
Okay. Jeff, you have any sort of fear and loathing about the future of tech?
I think it's in reverse. I think the speculation is happening in companies like Kohl's, who are making 25% less money in 2021 than they made in 2020, and the stock is making a multi-year high today. I think the speculation is in companies that are making a lot less money. Their business model is frankly something that should be subject to question. The GameStops of the world. GameStop is a mall retailer. These are the companies people are going nuts in. Like Roger was saying, these big tech companies, they're making hundreds of billions of dollars. They're killing it. They're crushing it. Yeah. They are the most bulletproof businesses on the planet. They don't need the government. They don't need the economy to be open. They don't need the vaccine. They make money. Rain or shine. So I'm nervous about just like this extra speculation that's happening in everything else That makes me nervous. But you can't fight City Hall. What Adam was saying earlier with this huge money on the sideline is a very real phenomenon. I mean, I went on President's Day weekend to try to buy some outdoor patio furniture, and they were like, "That's an awesome couch. Yeah, you want it? You can have it in April." April? What are you talking about? Yeah, April. That's the first time you get, and I'm talking like spending big money, thousands of dollars on a stupid outdoor couch, which is going to get ruined anyways. And they're like, "Yes, you will have to wait to April." And I was like, "Sign me up. Put me on the list. Take my money. I'm getting more anyways." So
I want it. You've just made me want it more.
Listen, people have this mentality right now. It's with stocks, it's with home improvements, with second homes, it's with new cars. There's the fervor everywhere. We all have it to a certain degree that are, thank God, blessed and on the good side of the curve here, because not everyone is on the good side of the curve. So you have to keep that in your mind.
Oh yeah, I have no problem keeping that on the good side of my mind. I'm surrounded by misery in the countryside here. People who, typically have to go to work to get paid and aren't getting paid, and they haven't. But we've got government subsidies. Canada being a socialist government, so it's all good. But all right, Adam. So then, how about your fear and loathing meter on the future of tech?
Yeah, I fully agree with Jeff and Roger here, and James, to your points earlier. There's no question we've got one of the biggest, not fear of missing out trades, but what I call pent up demand. When all those people that have been really adversely impacted by COVID financially, that is, which is a big portion of the world, come back to life, and the money starts flowing again, not just from government stimulus, but from the real economy. They get paid, they go do work, like you said, James, and then they make money and they come home and spend it. That's going to be even more of a boost, JeffZ, to your point about, hey, we've got a truckload of demand out there. When you go anywhere, I mean, places are packed. I don't know, it depends where you are in the country, so on and so forth, but down in Florida, it's almost like there's no COVID. You've got people walking around. They're going to the beach. They're going to the pools. You've got travel through the roof. You've got people coming from all over the world. The parks, Disney. I took my kids to Disneyland the other day. You have to wear masks and you get the temperature check. Universal packed as well. So you've got restaurants are packed. It's not just Florida. Yeah. It's all over. It's all over. We talked about lumber, James, also buying lumber. And prices are through the roof. So just keep that in mind as we go forward. Roger, you want to jump in?
I just wanted to just back up everything you're saying. My wife and I, we went south for the Valentine's weekend to Miami, and we were in South Beach. And honestly, if you basically, I'm just saying yes to everything you were saying. That and it's one thing reading about it, but it's another thing doing it. And every restaurant we had to call 12 restaurants to make a reservation. We had to wait 20 minutes for a hotel for the elevator to be empty enough so we can go in, because so many people were going in, up and down, and you have a restriction of how many people. It was insane. It was busy. There was a 45-minute wait for the hotel breakfast restaurant. It was, you had no, it's exactly what Adam just said. It was very interesting, because here in Ponte Vedra Beach, we kind of live in our own little bubble. So it's hard to determine things from the real world. But when we went to Miami, it was business as usual. It was everything was all open, and it was wonderful.
And now look at the airline stocks, or look at the restaurant stocks, or look at the shipping stocks, or look at the tankers, which all have been, there's more travel stocks in general, which have been really depressed and undervalued. I used the air quotes there for months, but now they're coming back to life, and they're doing it in force. The cruise lines also. And that tells us there's a truckload of pent up demand, which will lead to more buying and higher stock prices down the road. You couple that with all of the trillions and trillions of dollars that's being injected into the system, not just from the US government, from global governments, and you've got almost a perfect storm for higher stock prices. But the caveat here, James, is that tends to precede a bubble or a climax top, or those are the ingredients for what usually happens at the end of a bull market, not the beginning of a bull market. So I really want to stress that point.
Absolutely.
Yeah, well, as the old adage goes, bull markets beget bear markets, and bear markets beget bull markets. And so that's really, I guess, just a matter of time until but that's my sort of my big pontification question mark for this year, 2021. Are we going to see just like March style corrections that are poof, here and gone in 60 seconds? Or are we going to see a prolonged revaluation of the entire marketplace to the downside if, for example, people don't get enough money to go back to work and spend? The government doesn't keep going with the stimulus. The trade by the big money is over Wall Street, and they can't bring themselves to pay $1,000 a share for Tesla anymore. And now they've moved on to the commodities thing. I mean, that's, to me, it's like, yes, you're right. They make money like nobody else on earth, and they are solid businesses. That's true. But their valuations have increased by, in some cases, 500% in the matter of weeks or months. And that kind of exuberance is just not sustainable historically. It always results in a corrective measure of some sort. So that's what I'm debating. I mean, I'm a commodities guy. I play the derivatives of commodities, not in their futures, but in the stocks of the companies that produce the commodities. So I'm extremely bullish that finally, now all the attention is off the major techs, it seems, for now, and it's coming over to commodities. And I'm like, hey, I've been waiting for this for 10 years. Come back. Great. Finally, copper stocks. Woohoo. But so, there's a part of me that really cheers for the idea of a collapse in the tech bubble. And
James,
so that's obviously.
If you have a collapse in the tech bubble, you're going to have a collapse in everything because of the size of the companies. They're $1 trillion. I mean, like
Market
we're talking
cap,
about like $7 trillion in combined market cap. We're not talking about, people love to compare 99 and 2000. Roger was saying this, but let me take it a step further. They were little JV companies. This is the varsity team. They had a couple of $100 million market caps. These companies have bigger market caps than the entire market cap of some countries. Yeah. Germany, for instance, has a $2 trillion market cap. Apple's bigger than Germany. Keep perspective on this thing. You have to have perspective on these companies. They're not just names. They're entire economies in themselves.
But to what extent are those valuations the result of exponentially banked out quantitative easing?
We doubled our debt in a year. We doubled the national. Remember, you used to walk around Times Square and you'd be like, oh my God, look, that's 10 trillion. It's 30 now. It's like the number is so incredibly, existential at this point that who knows? But that has a derivative effect on the valuation of everything. That's why you have $2 trillion tech companies. Sorry, I had to say that.
And just look at FANG stocks. Those FANG stocks, those 5 or whatever 6 FANG stocks, they have more market cap than the 96 or 90 other stocks in the Nasdaq 100. What Jeff is saying is 100% right.
They're hotels. They're like
you can't
for the capital.
If those tech stocks is what's driving, I mean, the rest of it's just too much. This is not Amazon or Netflix of 20 years ago. It's a different world we live in. So yeah, and just to add to Adam's point in terms of the ships, what he was talking about, the ships, the airline stocks, and other industries that have that pent up demand over the last couple. Think about, and I did an article about this, Adam, last week. Think about elective procedures. We haven't had elective procedures and surgeries. Do you know that 80% of hospitals make their cash from elective procedures?
Great point.
Well, they're starting up.
Such a good point.
Yeah, they're starting up again right now. So all of these things that were off the table for the last couple of years are now starting to make a comeback. But yeah, I think what's going to happen, James, is I think you're going to see a very lopsided market with a lot of market cap in specific industries and very suppressed industries. You're not going to see a very even market. And then what's going to happen is we're going to have a couple of these corrections, and these corrections really help the market kind of become arbitraged, if you will, on a stability level. But I think that's more in line than just seeing a meltdown, an overall meltdown. I think that's more likely, in my opinion.
Okay, so great. I'm glad to see I can elicit passion. That comforts me. Okay, so then I always put my mind towards the latter part of our roundtable in the mind of our viewers and our subscribers. And if, I try to think of how can we deliver them one sentiment that they can sort of take to the bank and do something with. And it's concrete and it's clear. I mean, at this point, we've basically argued for commodities and technology stocks and ETFs, but for the guy at home who's got maybe call it $1,000 to deploy into a Robinhood trade today, we haven't given any clarity. So at this stage, Roger, what would you tell your Reddit investor at home?
I'm not ready to throw in the bull towel just yet. I think what we're seeing right now, anytime the market sells off, I think these are opportunities. I think till we get deeper into this presidential election, we're not going to see signs of major pullbacks. Cracks in the road, absolutely. It's impossible to get to these levels. Higher volatility, without a doubt. Possible pullbacks again to the 50-day, maybe even to the 200-day. Very likely based on everything we're seeing. But real sell-offs, real selling pressure, where you see massive market cap being wiped out, I'm just not seeing it yet. Not till maybe another couple of quarters, if that. And again, as far as where they should be putting their money, smaller cap stocks, smaller cap tech stocks, smaller cap pot stocks, smaller cap renewable energy stocks. I'm still seeing a lot more upside and a lot of pent-up demand in smaller stocks. And my favorite sector for this quarter is if you can combine some sort of technology with a foreign company. Like, for example, SE, C Limited, JD, Mercal Libre. These are all the stocks that I've been talking about over the last year that have tripled, quadrupled in price, and there's no sign of stopping them. So if you can combine technology with a foreign government, I think that's a very smart play right now, and stick to smaller stocks. Growth stocks, not stay away from blue chips. This is not a blue chip season. This is a growth stock season. So that's what I have for our readers today.
All right. And JeffZ, what's your pearl of wisdom for our favorite viewers today?
I'm going to talk about strategy. This is going to be a trader's market this year. When the market's up that day, that's not the day to buy, because you're going to have a down day in 3 days. Buy on the down day. Understand that there's going to be waves this year, because we are entering a regime of market environment that I like to call bullish volatility. What does that mean? It means that the market as a whole is trending higher, but with bigger bars, bigger range bars on a daily basis. When you have a normal early bull market, you have very minuscule range bars, and you'll see the VIX is at 10, at 15, which means the stocks aren't moving a lot every day, but it's steadily going higher. What we're having now is we're having much bigger ranges. We're having down days every third day. We're having triple-digit gains almost every single day in the NASDAQ, almost every other day in the S&P. So if you're not a trader, join me. I'll teach you how to trade. If you're an investor, don't get FOMO and chase stocks when they've been up 4 days in a row. Wait for the rain and buy them when that dump comes, because invariably you're going to have a lot of those this year.
All right. And finally, Adam, what's your genuine bon mot for the closing argument?
Sure. I'm going to just echo what I mentioned earlier about the travel stocks and the back to normal stocks. Those areas are obviously catching a very strong bid. I think they're in the beginning state or early stages of a big move higher, especially as the vaccines continue to be rolled out and the pace of vaccinations are going up, COVID cases are going down. So that should bode well for that area. James, to your earlier point, we spoke about earlier that these are some of the signs, the ingredients of a top, or ingredients of what happens near a top, or that type of stuff. With the commodity world, specifically gold, it's almost left for dead. Bitcoin's taken the spotlight, other areas, blah, blah, blah. But if you look at a gold, the thesis for gold, it remains extremely strong. And the fact that nobody is talking about it, and the fact that nobody's bullish on it, and the fact that it just held its November lows right now, to me is just a extremely good opportunity to get into gold and gold stocks, because just like those are the ingredients for a top, that's the ingredient for a bottom or for a turn higher, when people just write it off and it's left for dead and forget about it. Bitcoin ate its lunch. So whatever other nonsense you want to say, that's the time where the smart money's in there buying very aggressively. So that's another area that I'm very bullish on going forward, providing that the recent lows and the November lows hold, of course.
Awesome, gentlemen. Well, that's a great discussion today. As per usual, I'll look forward to talking to you throughout the week. Thanks for your time today. Have a great week.